Hello everyone, let's continue our journey of the monetary models. In the previous two lectures, we have introduced a money market into our real business cycle model. It has a supply side and demand side like any other markets. On the supply side, MS, the supply of money, is equal to a multiplier multiplied by M0. On the demand side, the MD, the demand for money, is equal to price multiplied by a liquidity function, which is a positive relation with output Y and a negative relation with nominal interest rate R. The nominal interest rate, the price of money, and it is then determined by the Fisher equation, which links the real interest rate little r and the nominal interest rate big R. But up to now, we haven't discussed the role of government in the monetary model. But we all know that monetary policy is a very important tool for the government to intervene the economy. In practice, many central banks, which is the division of the government implementing monetary policy, they claim to be independent from the rest of the government. But in reality, they all have collaborations with the rest of the government. They have to combine their tools together to fight the recession. For the US, the central bank, which implements the monetary policy, is the Federal Reserve. For the UK, it is the Bank of England. And for the Eurozone, it is the European Central Bank. This lecture has a lot of learning objectives, but basically there are two types. The first type of learning objectives include the first three. They're basically the same thing. You have set up a government budget constraint in this model and then derive the equilibrium in this model, and the conclusion is called neutrality of monetary policies, or aka the classical dichotomy. This is the first set of learning objectives. The second set is some extensions of this monetary model. We introduce a new model called Friedman-Lucas money surprise model, which gives you non-neutrality of monetary policies. And there is another extension of the model when you have zero lower bound and quantitative easing. And these two learning objectives are extensions based on the basic model. So now let's look at how do we introduce the government's role into this monetary model and then derive the competitive equilibrium in this monetary model and derive the conclusion of this model, which is called neutrality of monetary policy. Well, government is not new to us because in the previous semester, we have introduced the fiscal policy of the government in the real business cycle model. It's basically a balance between the expenditure and the revenue of the government. In the static version of the RBC model, the government's expenditure in this period, G, must be equal to the tax revenue in this period, T. And in the dynamic version, it's a little bit more complicated because you can borrow, and G has to be covered by T and B. B is the government bond today you owe to the public. In general, you could have a previous period, so you may have to spend both G and 1 plus R multiplied by B minus. B minus is the bond you owe in the previous period, so this is also an expenditure in this period. And this total expenditure has to be covered by T and B. In the monetary model, however, we have something more here because the monetary policy has to be considered. The government now can also finance its expenditure using the monetary policy. That means you can issue more money. You can just print money so that you can purchase your G. Another difference is that because we have a monetary model, so everything has to be purchased by money, and G, which is the real units of output, has to be multiplied by P. P is the nominal price of each unit of output. So everything here has to be multiplied by P to give you a nominal value. But other things like B minus can also be there, but you have to interpret that as the nominal value of government bond. And B is also the nominal bond values, not the real bond values. Okay, M minus M minus is the increment of the money balance in the economy, which is the new money issued by the government during this period. M minus is money balance in the previous period. So anything, any superscript with a minus means the variables in the previous period. Yeah, all items are denominated by money. So G has to be multiplied by P, T has to be multiplied by P, but B and M are already nominal by definition, so you don't have to multiply them by P. And this is the difference between the real model and the nominal model, because the government has a role to issue more money to finance its government expenditure. So that is the first learning objective achieved. We have seen how to introduce monetary policy into the government budget constraints. You can basically issue more money to cover your government expenditure, G. Now let's move on to the second learning objective, how to derive the competitive equilibrium in such a monetary model. We still have three conditions to hold for competitive equilibrium, just like in the RBC model. The first one is all consumers have to optimize. That means all the intratemporal conditions and intertemporal conditions has to hold for the consumer. Second, all firms have to optimize. That means the same. The intratemporal conditions and intertemporal conditions have to hold for the firm. And the third one is the government makes its ends meet. So the budget constraints we have just seen in the previous slide has to meet over time. And the last one is, you have to have a clearing markets, all markets clear, including the labor market, credit market, capital market, goods market, and money market. So all the endogenous variables in this system includes the labor N, bond B, investment I, capital stock K prime in the future, consumption C, output Y, profit pi, taxation T, money demand MD, and they are all endogenous variables for the individual firms and individual consumers as well as the government. The rest of it, the blue variables, W, wage, R, real interest rate, big R, the nominal interest rate, and inflation, which is just the change of price, P. These blue variables are exogenous variables to individuals, but endogenous variables for the system. This is the same as before. I just emphasize it over again, in case you forgot that. And we have exogenous variables like productivity, Z, government expenditure, G, which is determined by the law, so it is exogenous. MS, which is determined by the government, again, so it is not determined within the system, within the economic system, but outside the economic system. And these exogenous variables are changing out of the economic variables. So you have to use these exogenous variables to express the changes in the endogenous variables. The causes are the exogenous variables, and the effects are on the endogenous variables. So the mathematical solution of this equilibrium model is that you will be able to express the endogenous variables in the upper line in terms of the three exogenous variables in the second line. Okay, so basically that's the mathematical logic. The mathematical logic of solving the equilibrium is to express endogenous by the exogenous. But fortunately, you're not required in this module to solve the endogenous in terms of the exogenous, just like what you did in the previous semester. Instead, we're going to use graphs to derive the equilibrium. But the logic behind is exactly the same. When you want to solve the endogenous in terms of the exogenous, that means you will have to get rid of all the endogenous variables on one hand side and only keep the exogenous variables to express one single endogenous. That means you can't have two endogenous variables in one equation or in one relationship. You can only have one endogenous variable in your solution, and everything else are exogenous to express or to determine your endogenous variable. There will be some steps to get the general equilibrium. The first step is to get some partial equilibrium first. When partial equilibrium is determined within each market, and general equilibrium is determined in all markets. So we have to have partial equilibrium before we go to the general equilibrium. Now let's look at the money market on its own, leaving aside the other markets like output market, labor market, or whatever. We just focus on the money market itself. So we will have a partial equilibrium. We have money supply and money demand and money clearing condition in this particular money market. And we know that the money supply is determined by the government. This M, this green thing, M, is determined by the central bank of the government. So you don't really have a choice or control over this. That is why it is a vertical line in the graph, because MS, the money supply, is not your choice variable, but the government's choice variable. So it is vertical. And money demand, as we have just seen in the previous lecture, the money demand is equal to price multiplied by the liquidity function. And the liquidity function is a positive relationship with output and negative relationship with interest rate. But if you are talking about this relationship between MD and price, it is a positive relationship. So when price increases, MD increases. It's very straightforward looking at this equation. P increase means MD increase. So in this diagram, which has a vertical axis of P and horizontal axis of M, MS is a vertical line and MD is a positive line. Now, if you clear the money market, that means supply and demand has to meet. Then that is the intersection of the two lines, and that gives you the equilibrium or partial equilibrium of the money market. And we know that in this case, it is equivalent to say that Fisher equation holds, because once the money market clears, that means there's no arbitrage opportunities, and that means R has to be equal to little r plus inflation. They are actually equivalent. So this is the partial equilibrium in the money market, and we show this using graphs. Now we have seen the partial equilibrium in the money market. We are ready to combine with other markets to achieve the general equilibrium. We know that apart from the money market, we also have labor market and goods market. Actually, we also have capital market, but we don't show that usually. It's quite complicated if we show all the markets in one go. So in all economic analysis from this slide onwards, we will just focus on one most important input market, that is labor market, and one output market, that is the goods market. Okay, this is exactly the same as we have seen in the previous semester. The labor market shows you the labor supply and labor demand, and they are derived from the consumers and the firms optimization problem. And this is actually the intra-temporal conditions for the two individuals. And the goods market has its supply curve and demand curve, and they are also derived based on the consumers and the firms optimization problem. So basically, the real sides of the economy, see, these are both real sides of the economy. There is a supply and there is a demand, and they meet in the partial equilibrium. And we already derived the partial equilibrium in the money market as well. Let's combine the three. And we can see that if there is a change in the money market, let's say there is a change in money supply. Okay, the government decided to increase its money supply from M1 to M2.
Will there be any effects? Well, there is. For example, P1 has to increase to P2, so the nominal price of goods will increase. There will be an inflation. However, it has nothing to do with the real side of the economy. As you can see, there is no change on the supply side or demand side in either the labor market or goods market. So anything that changes in the money market will not have any effect on the real side of the economy. And this is what we call neutrality of monetary policy, or dichotomy.
So this is actually the third learning objective. We have derived the classical dichotomy. That means what happens in the monetary side of the economy will only have effects on the monetary side of the economy, and the real side of the economy has nothing to do with the money or monetary policy. This is also what Friedman on monetarism has said. Inflation is always and everywhere a monetary phenomenon. So if monetary policy changes, it is always related to the inflation and has nothing to do with the real side of the economy. It is also called neutrality of money because the monetary policy effect is neutral to the real side of the economy. If you are Greek, you will know what this means. It means leaves the world of Caesar to Caesar and leaves the God to God. And this is similar to our classical dichotomy, right? The monetary side is only to do with the monetary policy, and the real side of the economy is only related to the real side of the economy. And they are not interacted at all. The only link between the real side and the nominal side is through the Fisher equation, where big R and little r are connected by the inflation. But inflation is just a nominal phenomenon anyway, so it still cannot affect the real side. Give you an example. If Bank of England suddenly announces that £1 is now £100, then the only effect is that prices will just be 100 times, with no real effect on how people make decisions. However, neutrality of money only holds in the long run. As Keynes ever argued, this long-run attitude is misleading, because if monetary policy is neutral, why do we care about using monetary policy at all? And this is where the famous quote, "In the long run we are all dead," comes in. So economists has to talk about both the long-run trend as well as the short-run fluctuations. Otherwise, it doesn't matter anyway. So in the short run, monetary policy can matter if some assumptions hold. And as you can see, the Keynesian model, which you have been learning in your first year, the ISLM model, tells you that monetary policy actually matters. And there are also other models I listed here, but you're not required to know. They are all in gray. The only model we are going to discuss is the Friedman-Lucas monetary model. That is a money surprise model. And this is a model of the short-run fluctuation of the business cycle. And in this model, when monetary policy can create some real effects.
We mentioned that the Keynesian or Higgsian model can generate some non-neutrality of money, but their conclusion depends on their assumption of nominal frictions. That means you can't change your price or wage freely as much as you want. There is price or wage rigidities. In contrast, the Friedman-Lucas model do not require these nominal frictions to generate the non-neutrality. Instead, they assume that the workers and consumers have imperfect information about the aggregate variables when they make decisions. The imperfect information means you do observe nominal wage. Well, that is easy to check. You just check your payslip. But the real wage is unobservable, because the real wage, the little w, is equal to the big W, the nominal wage, divided by the overall price level. Because you don't know the price level overall in this economy, you will have to estimate how much P is, so that you can have an estimate of this real wage. And your decision making, as we have seen in the previous semester, depends on the real wage rather than the nominal wage, because what really matters is how much potatoes you can have after getting your wage, not how much pounds you get, because it really depends on the price level of potatoes when you can purchase it using your nominal wage. So in Friedman-Lucas model, there are two possibilities when there is a rise in the nominal wage, big W. One possibility is because of the rise in money, or due to the nominal shock. The second possibility is due to a rise in Z, or productivity, which is a real shock. If it is due to the nominal shock, then the change in the nominal wage is purely due to price, or money. So the real wage, little w, is not affected, and decision-making on real variables, such as employment, should not be affected at all. And this is what we have derived in the neutrality theorem. However, if it is due to the second reason, then the change in the nominal wage is purely due to little w, or due to the productivity. This is a real shock, and when the real wage is changed, the decision-making will be changed. And this is done through the real side of the economy in the intratemporal conditions. Therefore, an unanticipated increase in money supply can actually fool individuals to work more in the short run, because the individuals cannot distinguish between these two cases. They have to make a guess which one is which. And on average, there will be some people think the first case is the case, and some other people would think the second case is the case, and mix it up will have a real effect on the whole economy. And the graph shows you the three positions of labor supply curves. And the first one is when you don't have any effects. And the second one is when you do have effects. And the third one is in the middle. And this is what reality would rely on, because people have to make a guess. And as long as it is a guess, it could be wrong. So there will be a simultaneous change on the supply curve, but this supply curve won't be as much as if all the change are coming from the real shock, and it won't be the same as the original equilibrium, because people cannot distinguish between these two shocks. So let's talk about some policy implications for the Friedman-Lucas model. In contrast to the Keynesian models, which we are going to focus on later on in this course, non-neutrality of their monetary policy supports an active role of central banks to fine-tune the economy. So if there is a recession, the Keynesians think that the central banks should increase the money supply. And reversely, if there is in a boom, then the Keynesians think that the central banks should decrease the money supply to cool down the economy. However, in Friedman-Lucas model, non-neutrality comes from the uncertainty of the policies. And this is something Friedman, especially the monetarists, don't like, because it will fool people around. They try to minimize the money surprises, so they think the reverse of the Keynesian models. They think that you should minimize the intervention as much as possible. And whatever you do will send confusing signals to the public, and that will reduce the authority and effectiveness of monetary policy. This is just like what Abraham Lincoln ever said: you can fool all of the people some of the time, and some of the people all of the time, but you can't fool all of the people all of the time. So basically, the model we have introduced, the Friedman-Lucas model, is the core of monetarism, which is the prevailing school of thought in economics in the 1960s until 1970s. There are two most important policy implications from monetarism. The rule over discretion is the first one, because they basically advocate the disciplined central bank rather than a discretionary central bank. They advocate a predictable money growth rate rather than an unpredictable money growth rate. The second policy implication is gradualism. So if you have to do something to reduce the inflation, for example, then you have to do it gradually. Don't do it in one go. Otherwise, people will just be in shock. And this is just like you want to go down from the 10th floor to the ground floor. You can either go gradually, step by step, and then you are safely landed, or you can jump out of the window and die. So which way you would choose? Like any economic theory, Friedman-Lucas model also has its limitations. The monetarists' monetary policy recommendations depends on the stability of money demand function. That is, the red bit here must be very stable over time. However, if it is not, then it will be very difficult to distinguish between a monetary supply shock and a money demand shock. If there is an increase in money supply and there is a demand shock at the same time, then the effects on price will be very, very unstable. And any policy implications rely on this stability of liquidity function will make things more complicated. So anything like new information technology or new financial instruments and change in the regulations, they will all make the liquidity function very unstable. In practice, after the 1980s, money demand function became more and more unstable, and most central banks discarded the money growth rate targeting, which is also called a quantity instrument because it relies on the quantity of money supply. They then turned to the interest rate targeting or price instrument because interest rate is the price of capital. They try to use a more robust instrument to avoid sending confusing signals. Because if you are relying on the Friedman's suggestion, then the money growth rate is stable, but the interest rate will be very unstable. So after the 1980s, Taylor rule becomes the new norm to announce the monetary policy. It is also a so-called feedback rule in monetary policy because the Taylor rule sets the interest rate in response to inflation and output gap. There is, of course, limitations of the Taylor rule. We all know that the nominal interest rate is very difficult to fall below zero. However, in practice, there are some countries having a very close to zero or even negative interest rate. But in most countries and most of the time in history, interest rate cannot fall below zero. Do you know why? Think about it. If the interest rate is negative, that means if you borrow £100 today, you only have to return 90 pounds tomorrow. What is a good deal? What would you like to do in this case? If I were you, I will borrow as much as I can because you are spending for free. And over the years, then you will have nothing to send back to the bank because the interest rate is negative. So in practice, this is not really possible. But in theory, it could have a negative interest rate And it actually happened in history in a very small number of countries like Japan and Switzerland. But normally, the central banks can control the market interest rate if it is still positive. They do it by the open market operations. They can do it by buying or selling the short-term government bonds. It is very important to highlight that in normal times, central banks are selling and buying short-term government bonds. It's usually less than 1 year, the maturity. But when the interest rate is very, very low, or even equals to zero, hits the zero lower bound, in these rare cases, it is also called a liquidity trap, because the short-term government bonds is no longer effective for the central banks to affect the interest rate. It's already zero. How much can you do on it? You can't go negative, so you can't do anything about the short-term interest rate. The only way to do that in this kind of difficult liquidity trap time or recessions is the quantitative easing, or QE. This is what you often hear about, especially after the global financial crisis. The QE are used by the central banks to purchase the long-term government debts. And these are not the same as the short-term government debts, because long-term government debts usually have a higher interest rate compared to the short-term government debts. And those are still positive. So if you can do something about those long-term government debts, like 2 years maturity or 5 years maturity, then you can still provide more liquidity to the market. The only difference is that you are no longer using the normal ways by buying and selling the short-term bonds. But basically, the essence is the same. You provide liquidity by selling and buying these long-term government debts. Something like QE1, QE2, and QE3 in the US are the 3 waves of QE. And it does have some effects, but still, once you are trapped in the liquidity trap, then the Taylor rule will be very ineffective. To summarize, we begin our discussion today by introducing the government's budget constraints with the monetary policy, and that expands our discussion of government's role in the economy. And secondly, we derive a competitive equilibrium of the monetary model with the RBC as the real side and with the monetary policy as the nominal side. And we derive that monetary policy is neutral, or we call it the theorem of dichotomy, because money doesn't affect the real side of the economy. And in the short run, the various models can explain the non-neutrality of monetary policy in reality. One of those we discussed today is Friedman-Lucas model, which assumes imperfect information, but do not require nominal friction. Another model we are going to discuss in the next part of this course is the new Keynesian model, which do require the nominal friction. Remember that they have different assumptions. One is imperfect information, another one is nominal friction, but they have exactly the same conclusion, that is, monetary policy is non-neutral. But they do have different policy implications. For example, the Friedman-Lucas model thinks that you shouldn't intervene if not necessary. But new Keynesian models, which we are going to discuss, thinks that you should intervene actively using the Taylor rule. Before the 1980s, Friedman-Lucas model, or monetarism, is the mainstream of monetary policy, and most governments try to use money growth rates or stable money growth rate as the instrument of monetary policy. But after the 1980s, a key requirement for monetarism is violated. That is, you don't have a stable money demand. And after 1980s, Taylor rule becomes the mainstream. And during the crisis, especially after 2008, Taylor rule is also not effective because it's touching the zero lower bound of monetary policy. Therefore, QE is invented. The quantitative easing is invented. And governments use not only the short-run government debts, but also the long-run government debts to provide liquidity to the market. For further reading, please look at Chapter 12 of Williamson and try to do the self-tests. Have fun!